Fed officials downgraded their growth forecasts this year, with most seeing a contraction of 0.5 to 1.3%. That's from the minutes of the Fed's January meeting released just a half hour ago. Fed Chairman Ben Bernanke telling the National Press Club that they will begin releasing longer-term projections for inflation, growth, and unemployment to help anchor public expectations. For more on this, we're back with Kathleen Hayes and with former St. Louis Fed Bank President Bill Poole. And also joining us for a roundtable is Robert McTeer, the former Dallas Fed Bank president. Thank you all for joining us. Mr. McTeer, let's get you in here first. What did you think of what you read in the Fed minutes?
Well, the regular minutes were as expected. Most of the real conversation had to do with the assets that they were purchasing and the advisability of various kinds and so forth. And then the telephone conference surprised me a little that they were talking about an inflation target at this time. But it looks like they didn't really make any decisions on that.
Well, you know, Bob, according to our Bloomberg News story, it appears that they are moving towards this a 2% target. That's how we flagged it. And we asked Bill Poole at the top of the show, who also really had a chance to read the minutes, what it means that the Fed is pointing towards something like that. No matter how much it's spelled out, that they're saying we got to give folks a long-term view and set an inflation anchor.
Well, they may have done that elsewhere. I just didn't get that out of the minutes of that special meeting. That seemed to just sort of end without any conclusions.
Well, Bob, more broadly, were you surprised at how negative they were on the economy? They're not just downgrading their forecast for this year. They're saying that unemployment's going to get to almost 9% by the end of the year. They're also saying only a very slow recovery in 2010 because of the financial problems. Maybe we get back to normal by 2011. Is this current crop of Fed officials being a little too pessimistic?
I doubt it. You know, unemployment reached 10.8% in 1982, so 9% is not all that high by comparison. And right now, it just feels like the bottom is dropping out. Consumer spending is declining, and what used to sustain it has turned from positive to negative. Investment is going down, and the strengthening of the dollar may put at risk the recent improvement in the net exports. So about all you have right now is G in the breakdown of spending categories.
Mr. Poole, Lori Rothman here. I had asked Kathleen earlier, we were having this discussion about how you think, I'm trying to get your impression now, Mr. Poole, about how Bernanke did in terms of boosting the government's reputation among the American people with so much criticism of late for the federal government and how they're handling the recession and economic crisis.
The chairman was talking principally, almost entirely, about the Federal Reserve's responsibilities, and I thought that he was very clear. I thought he was transparent. There were some things that I would have put greater emphasis on, particularly that the Fed's enormous balance sheet expansion will have to be reversed, which he did say, but the reversal will include some interest rate increases, and that may the public needs to understand that. I think that the minutes were quite interesting. My friend Bob McTeer noted that special meeting was very ambiguous, non-committal in terms of an inflation target. However, the Fed launching here the long-term averages that the FOMC members expect is doing essentially the same thing, a pretty narrow range. We should understand that in the long term, the Fed, and only the Fed, is responsible for the rate of inflation. The Fed has very little, practically nothing to do with the long-run rate of unemployment or the GDP growth. So the Fed's estimating that unemployment is going to average, let's say, around 5, depending on the members' individual views. That's determined by the structure of the labor force and other matters such as that. But the Fed alone is responsible for that long-run inflation rate.
Well, gentlemen, looking at what the Fed put out in its forecast, we can see that their longer run view of PCE inflation is 1.5 to 2.0%. And it's, again, this focus on inflation. But let's focus on something else as well, because we've got a couple of things going on. For example, the president has now signed a pretty aggressive plan to help homeowners on top of the fiscal stimulus bill that he just passed. Let's start with you, Bob McTeer. Is any of this going to work?
I'm more hopeful about the plan to help homeowners than I am the fiscal stimulus plan. I didn't think much of that. It was huge, almost unimaginably huge, but it was so scattered, and I don't think it's going to create a lot of new jobs, and it is going to create a lot of new debt. So I would place the emphasis on fixing our financial system and dealing with a housing problem. And I wish they had passed on that kind of stimulus bill.
All right, gentlemen, getting back to inflation, this 2% long-term inflation goal put out that we learned with the minutes, is that legitimate? Is that fair, considering the Fed's going to more than likely print money if it hasn't already?
Well,
yes, 2% is fairly high. Yeah.
Okay.
Bill Poole, can we give you a quick chance to weigh in on the fiscal stimulus package as well, and the home rescue plan?
Well, I agree with what Bob said about the fiscal stimulus. I would also note that the minutes of the meeting, the Fed itself suggested some concern that the tax part of it will have no lasting impact. There's some comment to that effect. It'll produce a temporary increase like the rebates that we saw last year. There will be a big increase in federal debt that will eventually, I fear, be financed not by cutting spending but by raising taxes. I am perhaps less optimistic about the mortgage plan. I think what will happen is that the mortgage plan will alleviate situation for certain borrowers, but it will not be very general and across the board. So there will be some lucky people, perhaps, who are aided, but there will be lots and lots of others who might have equal claim, who, for one reason or another, will not be assisted.
Okay, that's our roundtable. Bill Poole, a former St. Louis Fed president, and Bob McTeer, the former president of the Dallas Fed, joining us along with Kathleen Hayes. Thank you very much.